There's a lot of bad financial advice given on the internet. I mean, really, really bad financial advice. So much bad advice. And the reason why is obvious.
Just a moment, sir, if you please. You look like the kind of man of judgment who knows how to invest his money wisely. Won't you step into my office, please? Let me give you a hot tip, strictly confidential. For a limited time only, we are offering to discriminating buyers like yourself a few shares in a world-famous company with mines in Nigeria, Tasmania, Somaliland, and Brooklyn. It's Utopium Unlimited. It glows in the dark. Small investment, big profit. As a special favor, I'll let you have 100 shares for only 40 cents a share. That comes to $40. Plus, of course, $20 for putting you onto a surefire moneymaker. You are now a man of some...
The advice that frustrates me the most has to do with stock dividends. This advice isn't given by people trying to rip you off, but by people who misunderstand the difference between yield and income. For most people, focusing a portfolio on dividends is a terrible, terrible idea. In this video, I'm going to try and explain why. Let's talk a little about how the stock market used to work. Today, when you want to buy a stock, you probably log into a website, enter an order for the trade, and it will be filled electronically within seconds. Before the internet, this wasn't true.
The Colorado broker wires the order to his New York office. The buy order is telephoned to the floor of the New York Stock Exchange. It is given to the firm's floor partner, who becomes the representative of the buyer in Colorado. The floor partner goes to the post where ODM stock is traded. The representative of the buyer in Colorado bids $10 a share for 100 shares. But at the moment, there is no stock offered for sale at this price.
Placing trades in the old days involved paying large commissions, and before 1975, those commissions were fixed, no matter how many shares you bought. Buying just a few shares of stock might have cost you hundreds of dollars. If you were a small investor, that could eat up your profits. In 1975, commission prices were deregulated, and this led to the rise of the discount broker. Commissions got much cheaper, but were still huge compared to the commissions most of us pay, or rather don't pay, today. Even as recently as 2005, the average commission was about $10 a trade. It's only in the past few years that commissions have gone essentially to zero, so commissions have historically eaten into your profit. There was an exception to this, which was dividend reinvestment plans, or DRIPs. Stock shares purchased via a DRIP bypass the commission system completely and were a great way of increasing your position in a stock over time at a low cost.
Take, for example, a company whose stock is selling at $20 a share. If that company, over the past year, paid out $1 a share, the dividend yield comes to 5%. You can keep the cash, or if you wish, the dividends can be automatically reinvested for you. Now, the investment route you're traveling is a good one.
This is one reason why your grandparents feel strongly that dividends are great. They internalize dividends as a way to increase the number of shares they hold without paying commissions. But of course, hardly anyone pays commissions anymore. But let's back up a minute. What exactly is a dividend?
A successful business must have enough sales dollars coming in to enable management to pay the expenses of doing business, such as salaries and wages, materials and supplies, research and product development, plant maintenance and repair. In addition to all of these bills, management has to pay taxes to local, state, and federal governments. Any money that's left over is known as profit. Wise management plows part of it back into the business. The remainder of the profit is paid out as dividends. These dividends are sent back to investors as a reward for risking their savings in the American business system. although occasionally some of us pick a lemon and have to take a loss.
Dividends are a cash payment by a company to its shareholders. Periodically, often once a quarter or once a month, a company may choose to pay some number of pennies or dollars per share to each shareholder. So right off the bat, unsophisticated investors get excited. Isn't this exactly why we invest in businesses? Getting money back. Clearly, if we have two stocks and one of them pays me $100 in dividends and the other pays $0, that means the dividend-paying stock is better, right? Not quite. You see, there's no such thing as a free lunch. All things being equal, your stocks are going to fluctuate with the value of the company, along with other factors. Sure, the company sent you $100 in cash, but in doing that, the value of the company literally dropped by $100 in value. This effect is often obscured by the fact that there's normal volatility in the stock market due to supply and demand, but it is a real effect. You can see it if you zoom in on almost any dividend-paying stock on its ex-dividend date, which is the date the dividends are committed to be paid. So let's look at two fictional companies, BigCo and DivCo. Let's say that after 1 year, each company has appreciated in value by 10%. Both companies start at a value of $100 a share. On a certain date, DivCo is going to pay a very generous dividend of $10 per share. On its ex-dividend date, DivCo's share price will drop to about $100 a share. In other words, in theory, a dividend is a value-neutral event. It doesn't create money. It just forcibly converts some of the value of the stock that you already own to cash. But of course, we don't live in a friction-free world, and in investing, one of the largest sources of friction is taxes. Dividend income is taxable income. So you're going to lose between a fifth and a third of the dollars paid to you in dividends to taxes. So another year passes and both BigCo and DivCo have done well, rising another 10%. Except, because of the nature of compound investment, your BigCo shares have risen by a larger dollar value, $11, than your DivCo shares, which only appreciated by $10. If this pattern continues, then we can see that over the long term, all other things being equal, BigCo is going to generate a higher total return than DivCo. This is true even if you reinvest your dividends into DivCo, because although in that case your DivCo shares will have appreciated by $11, you had to pay taxes on the $10 dividend that was reinvested. You will eventually have to pay taxes on your BigCo gains, but not until you sell your shares, which allows you to maximize your benefit from compounding returns over time, and importantly, to choose when to incur the tax burden. As a general rule, paying taxes later is the same as paying less in taxes. There's another darker side to dividend investing, which is that companies are aware that many investors like receiving large dividends. So, of course, some of them offer shares that increase the dividends artificially, not by returning profits to the investor, but by returning the investor's own capital to them. In other words, these companies are paying a yield that isn't sustainable. We call this a dividend trap. Eventually, the company has to cut their dividend or go bankrupt. In either case, the value of the company will drop, and investors will lose a lot of money chasing them. There's no free lunch. When you see a company with dividend yields that are unreasonably high, you should read that as a risky investment. And this definition changes over time, and humans are bad at remembering this. If you were investing in the early 1980s, the 10-year Treasury bond, which we can think of as a risk-free investment, yielded almost 16%. Someone who started trading back then hears of an investment that yields a 7% dividend and might think of that as low and therefore safe. But the 10-year Treasury bond yield today is just over 1%. So a 7% yield represents serious risk. Now look, companies offer dividends for a lot of reasons, and I'm certainly not saying you should avoid them as if they're unclean. All I'm saying is that when you evaluate what to invest in, you should be focused on total return and not get stars in your eyes just because some of that return is in the form of cash. Because in the end, you're paying for that cash. Most of the dividend investing boosters I see are taking this, look, you can get a free lunch angle that I'm criticizing here. There are, however, two other angles that are worth discussing. These aren't as bad, so let's deal with them in order. First, some people, particularly retirees, actually need an income stream in cash. Dividends, the theory goes, are a way of getting the cash you need without bothering to sell shares each month. This to me is connected to another fallacy, the idea that if you sell shares, you now own less of a stock. It's true, but it's not meaningful. The fallacy also dates back to the days when selling whole shares, or even lots of whole shares, was the expected norm.
The buyer could buy from 1 to 99 shares, which would be known as an odd lot. But a Colorado friend decides to invest in 100 shares, known as a round lot.
But in today's world, most brokers allow you to sell fractions of shares. The best practice is to think of your investment in a stock as being in a number of dollars rather than a number of shares. In reality, if a company sends you a dividend and you don't reinvest it, you now own less of the stock in the exact same way that you would if you sold the same number of dollars of shares of a company that doesn't pay dividends. They are mathematically identical. So the idea of getting an income stream to live on from your dividends isn't outrageous, but I still think it leads people to invest in things that are riskier than they think. If I needed to do this today, instead of using dividends as my tool of choice, I'd look to some sort of robo-advisor or automated investment service. I'd tell it how much in dollars I wanted each month and let it automatically sell shares to generate that stream of dollars. I'd still have to pay capital gains taxes on my gains, but I'd be getting exactly the amount of cash that I needed when I needed it, minimizing the tax drag. A more sophisticated justification to choose dividend investing is the belief that it will lead to a better total return. The theory goes like this. If a company can afford to pay increasing dividends over time, that's a good fundamental indicator that it's a well-run company. The claim is that one should invest in these dividend-increasing companies, sometimes called dividend aristocrats or dividend kings, not because you want the income stream, although that's nice, but because it's a good way to pick companies whose stocks will probably grow more. It's just another method of picking good companies. Honestly, I'm kind of fine with this. I'm not sure I believe it as a general statement, and I think there's a lot of room for error. In particular, I think it may be difficult to distinguish between a good company that increases its dividend over time and a company that is struggling that does the same thing. But while I might disagree with the underlying thesis, at least it's an ethos. A bigger problem with this as a winner-picking strategy is that you're still subject to the tax burden that dividends cause. So to make this your guiding star, not only do you have to believe that dividend aristocrats are going to grow more, you have to believe that they grow enough more to make up for the extra early taxes that you pay. And that about summarizes my feelings on dividends. They have their uses and might be an indicator that you want to use for the health of a company, but for most people, in most situations, they're mostly a drag on your total return due to tax consequences. And seeking them out is a behavioral fallacy. Enjoy them when you get them, but don't go out of your way to make them an overly large part of your portfolio. This has been Counting Like It's 1479. Thanks for watching.